Greetings and welcome to another stock market related video in our CrashWatch series. And the last video I did was on April 22nd, and over 3 weeks have elapsed since then. So we'll look at what has transpired based on the topics that I discussed in prior videos. Now, in two earlier CrashWatch videos, which you can look at over here, as well as over here, in those tags in the upper right hand corner, I discussed a head and shoulders pattern on the S&P 500, which had not yet broken, but now it has. So we take this S&P 500 on a 2-year chart. Look at how I was talking about a head and shoulders pattern. Left shoulder, the head, which makes all-time highs, both correct down to the neckline over here. And the only reason this rightward neckline went lower than it was supposed to was because that was when Russia invaded Ukraine, but the entire stock market was not ready to correct yet, so it bounced back to create this right shoulder. And from the dates of those prior head and shoulders videos, which were across February and March, you will see that the crash was not imminent yet because this right shoulder had not fully formed. The shoulder is generally going to be a similar width as the left shoulder, but now we see that we have broken the neckline. The neckline was around here. The S&P 500 at 4350 to 4300. Now it is falling, and we take a smaller 1-year chart. You see this neckline, and then the neckline was still over here. And again, Russia invades Ukraine over here, but there's the shoulder, and now it's broken through this neckline and seems to be going straight down, as has happened over the last few days. So now this neckline is broken. That is very bearish and portends to a recession, and the Federal Reserve really should not be raising interest rates nor undoing QE, because they're going to be forced to lower interest rates and resume QE again because the stock market is going to fall quite a bit. How far is it going to fall? In my humble opinion, now don't hold me to this. Remember, these videos are for educational purposes and are going to be useful even years after the event, so don't necessarily make trades based on anything I told you to do. I'm just providing you a mechanism through how to learn about these subjects and make your own decisions. That's why these videos are not news per se. It's going to be useful even years from now. I say it can fall all the way to around 3,000 or thereabouts. Just because you look at this long-term trend, the Federal Reserve overreacts in one direction, and that's fine. That doesn't mean they should overreact in the other direction. They should just let this digestion occur. They did not print too much money. It's more that they printed in too narrow of a way only treasuries and mortgage-backed securities, which I have a lot of videos on this channel explaining more about that. But now I see this as falling all the way down to over here, as I describe in other CrashWatch videos. So the correction's not over. Some people are acting like it is because it's already down a certain amount from its all-time high, down 15% or whatever. That is not enough. I say it goes over here because this is not a low price relative to what you would have thought in 2019. In 2019, when we were here, if 3 years later it's over here, you would think, oh, that's okay, that's not so much. But because it rose so much, a lot of decisions were made here to lock in assumptions around this type of price. And the nature of the stock market is such that how much it rose in the past is less important than the fact that if it is below 20% from its all-time high for too long, the economy goes into recession because everyone becomes pessimistic and bearish and home prices get to negative equity and all those things happen. Even if in an absolute sense this is not a low level, this is a pretty decent level compared to 2017 and 18. The Federal Reserve is cornered in some way in that they can never allow more than a 20% correction to persist for very long, because then we have a recession. Despite how theoretical those PhD economists are, they react to this only after the fact. The only good thing I can say about them is before it took them 2 years to react to what was happening in the real world, now they react in maybe 4 to 6 months. So that's an improvement if nothing else, but they're still way too theoretical and no understanding of the true first principles of economics and technology and how mid-20th century economic assumptions do not apply in the 2020s anymore. And they're cornered. They still believe that money printing can be undone, as I speak about in a ton of videos all over this channel, and that they need to unwind their balance sheet when money printing has to be exponential, because that is what the stock market is demanding and kind of arm twisting them into doing. So they are fighting an unwinnable battle in the central banks of the world, especially the Federal Reserve, which is decades behind in their thought and very intellectually inbred. All those PhD economists only interact with other PhD economists who are hyper-theoretical and have memorized all the same models. When reality conflicts with their model, they're quite at ease with ignoring reality. But the stock market is going to fall to this level, in my humble opinion, in that it would not surprise me if that occurred. Again, don't make trades because of anything that I am telling you to do or not to do. If you have taxable gains, don't sell and repurchase, because then you will pay tax and you have to buy with after-tax money. And those are all various considerations for people. So don't do anything just based on this video. This is for educational purposes only. I have to say that very strenuously under these conditions. But this is how you look at a head and shoulders pattern, and how the Federal Reserve really creates all kinds of artificial problems that don't need to be created. And they should never ever talk about unwinding printing. They should only talk about how they can do more, and in a more diffuse way, because all market forces are portending in that direction. So when will it reach this low number? Could be pretty soon. I mean, it's falling almost every day. Last week, almost every single day was down, and every intraday rally turned out to be very weak and was quickly reversed. So let's see. CrashWatch is certainly in effect, and I urge you to look at all prior CrashWatch videos as well to get a more complete education about this whole thing. If you like this type of content and you found this video interesting, I encourage you to subscribe to this channel. Thank you very much for watching.